Hello, welcome back everyone. In this video, we're going to continue with Chapter 7, Financial Services in Your Daily Life. We're going to go over the main differences between a debit card and a credit card and go over the details of how credit card interest is computed. Let's get started. First, let's look at what are the best case uses for debit card versus credit cards. Typically, it's a good idea to use a credit card if you want to limit your spending to what you have. Remember that debit card is money directly from your checking account, so you cannot spend money that you don't have. Another good advantage of a debit card is that you will not pay interest because you are using your own money. Sometimes you can request a merchant to process a debit card as a credit card transaction. When you do that, you may take advantage of some of the protection that is available to credit cards, but it's not always guaranteed because you are using a debit card. Credit card actually have a lot of advantages too. Because it's a credit card, you can build credit history by paying off your balance every month. Using a debit card does not create a credit history. You can take advantage of credit cards' purchase protection programs. These programs differ from credit card to credit card, but most of them have some form of protection program. And the law actually requires that if you have a dispute with a merchant, the credit card company has to investigate that. If you are shopping from an unknown vendor, particularly an online vendor, that may be a good idea. A lot of credit cards also offer rewards or points, so that is another advantage of a credit card. But you need to balance that off whether or not the credit card charges you an annual fee. Because credit card is a loan, in case of an extreme emergency, you can tap into a credit card to pay for expenses when you don't have enough money. It is better to have an emergency fund. Even if you have an emergency fund, a credit card can be a backup option. Perhaps the most important distinction between a credit card and a debit card is the kind of consumer protection you have. Debit cards are covered under the Electronic Fund Transfer Act, which also covers electronic checks, ACH transfers. If you lose your card or if your card is stolen, you will be liable up to $50 if you report the event within 2 business days. That's a very short time period. So if you do, you should set up a transaction alert on your debit card so that if any transactions that you don't recognize occur, you get notified right away and you can report that to the bank within the 2 business day requirement. If you wait until within 60 days after you receive the statement, then you are protected up to, or your loss is limited up to $500. If you elect electronic statement delivery, which oftentimes a lot of us do because banks tend to charge money if you request paper statements. If you do not check your statement on a regular basis, you may or may not realize someone else has been using your card. Again, very important to set transaction alert. This coverage applies to when your card was stolen or if you lose your card. If the bank has a data breach and the card information was compromised, whether it's the bank or another merchant, so let's say you shop at a local grocery store and the grocery store's database got hacked and your credit card number was stolen, that is a compromised card information. You will not be responsible if you report the incident within 60 days of the statement. Once again, if you don't know that it happened and you don't report it, then you are responsible. Finally, the money that you use from a debit card will get taken out and it will be returned to you when the investigation is concluded. So let's say someone used your card and racked up $2,000 in charges. So the $2,000 was already taken out of your checking account. That amount of money will remain unusable to you until the investigation is concluded. Credit cards is protected under the Fair Credit Billing Act, a different legislation. For lost or stolen card, similar is up to $50, but is reported within 60 days of the statement. So you have a longer time period compared to a debit card. And you want to set up a transaction alert so you will know if your card is compromised. So same thing, if a card is compromised, it's the same as a debit card. You're not responsible if you report the incident within 60 days. So 60 days of when your credit card statement is delivered to you. This is probably the biggest difference between a debit card and a credit card. In a credit card, you don't have to pay the disputed charge while the investigation is ongoing. For a debit card, the money is already taken out of your account. For a debit card, as long as you file the report, then until they finish the investigation, you don't have to pay that amount. So the protection between the debit card and the credit card is very different. In general, credit cards has a lot more protection compared to a debit card. However, you need to be responsible and pay off the balance at the end of each month to avoid interest charges and not to spend money you don't have. So with a debit card, you cannot spend money you don't have. But with a credit card, you can. To review, debit and credit cards are very different. They look the same, but they are not. In a debit card, it's linked directly to your checking account. Every transaction is deducted immediately from your checking account. And you can only spend money that you have, unless, here's a caveat, you have overdraft protection. And we already talked about the advantages and disadvantages of having overdraft protection. It's usually a safer option to not have overdraft protection. A credit card is technically a loan from the issuing bank. The interest will begin if you do not pay off the entire balance by the end of the statement date. We're going to go over in details what does this mean and how interest is computed. Your spending is linked to your credit limit, not how much cash you have. And it's important, your credit limit is not money you have. The credit limit is how much money the bank is willing to loan you. Here are some advantages and disadvantages of credit cards. The good, you don't have to carry around cash. As long as you pay in full every month, you do not incur any interest. All your transaction history is recorded. You can download it. Remember when we build our budget and our statement of cash flows? By having your transaction history recorded makes budgeting a lot easier. It helps you build your credit, and it has strong protection against fraud and also unscrupulous merchants. The downside of credit cards include allowing you to spend beyond your means. And if you don't pay in full each month, interest on credit card is very high. The most important part and the most dangerous part is that unpaid balance on your credit card will continue to accumulate interest and grow at a compounded rate even if you don't make any additional new purchases. Credit cards requires a lot more personal responsibility. Here are a couple of suggestions. Pay off your purchase right away. That's one option. You do not have to wait until the end of the month to make payments. You can make payments on your credit card anytime. So if you want to use your credit card like a debit card, after you make a large purchase, for example, you just spend $80 on grocery and put it on your credit card, when you go home, pay that off. And most credit cards make it very easy to pay online. It just takes a few clicks to make a payment. So after you put away your grocery, make it a habit to then go on to your banking app and pay off that grocery purchase on your credit card. That way, you know how much money you have left in your checking account. Another option is to make 2 payments per month. Let's say you get paid twice per month. This is quite common. Then make it a habit to make a credit card payment on your payday. So after you check your deposit, your direct deposit, you saw that you get paid, log into your credit card account, see how much money you owe, make that payment. It takes only less than a minute to do, and it's a habit. Once you develop the habit, it becomes much easier to maintain. Since credit card is a very useful personal financial planning tool, how do we use it responsibly? How do we choose it? There are different types of credit cards. Some credit cards are issued by store. They are called proprietary card. That means you can only use that card to make purchase at that particular store. For example, Lowe's card, you can only buy things at Lowe's. Kohl's card, you can only buy things at Kohl's. Gas station card, a Shell card, you can only pay gas and also coffee and candy bar and donuts at Shell stations. In contrast, general credit cards you can use at any store accepting the card. Banks that issue general credit card, Citibank, Venmo has a credit card, Amazon has a credit card. Remember that all credit cards are issued by banks and credit card companies, not the merchants. So if you have a dispute on a Visa card issued by Amazon, you need to deal with Chase because Chase is the bank that issued the Amazon credit card. Here are some of the important things to take into account when you are choosing a credit card. First is fee. Look for credit cards that have no annual fee. There's very few situations where it's worthwhile to pay fees to own a credit card. There are lots of credit cards that have no annual fees. Interest rate. Be careful and watch out for teaser rates. A lot of credit card companies or banks will advertise low initial, no introductory APR. And that only lasts for a few months. If you have balance on your credit card, then the interest rate becomes important. If you are confident that you can pay off the balance at the end of every month, then interest become less important. But remember, if you are using the credit card as an emergency reserve as well, then it's a good idea to at least pay attention to interest rate when you are choosing a card. Credit limit. Remember that credit limit is not how much money you have. Also, to improve your credit score, you want to keep your spending to be less than 30% of your credit limit. So if you have a credit limit of $1,000, you don't want the balance to ever go over $300. Almost all credit cards offer a cash advance option. Cash advance means you can actually use your credit card to get cash. Remember, credit card is a loan. So when you use a credit card to make purchases, you are given a grace period to pay off the loan that the bank gave you to buy merchandise. And as long as you pay that off before the end of the month, you do not pay any interest. The reason that banks and the credit card company are able to give you that grace period is because credit card company actually charge the merchants who accept your card a transaction fee, and that transaction fee pays for your grace period. If you do a cash advance, that means you are getting cash out of an ATM from a credit card. There's nobody paying that transaction fee, so you have to pay it. So the interest rate will begin right away as soon as you take the money out. Sometimes they also charge a cash advance fee in addition to the interest. And the interest rate for cash advance is higher than the regular interest rate. A lot of credit cards have other features, particularly incentive or reward. This can be a good bonus, but if you have to pay a fee to get this, then then they may not be as good an option. The best kind of reward is a cashback reward. So if you get a 2% cashback, for example, that basically means you get a 2% discount on everything you buy. There are also some cards called Prestige card. They will give you access to airport lounges and special events and so forth. Those typically have very high annual fee. $200, $300, $500 a year. That's very expensive, and very few people really fully use those features. A reminder that there's a difference between credit card brands and the bank that issues the credit. The most common card brands are Visa, MasterCard, American Express, Discovery. These cards are issued by different banks. So American Express actually issue their own card. They have their own bank, and they have a smaller number of issuing banks. Visa and MasterCard have many, many banks. You are issuing banks. The most important thing to remember is that your contract is with the bank, not the brand of the credit card. So if you have any problem, you need to contact the bank, not Visa or MasterCard. Remember the financial protection laws that we talked about. Most of those laws require you to alert the bank within 30 days of receiving your statement. So it's important for you to check your statement on a regular basis. When you receive your statement, you want to ensure that all the charges that are listed are legitimate. Also, it's important to check whether or not you have any late payment fees or interest charges. In 2009, there's a new card act. We talk about that briefly in the Consumer Credits chapter. And an important provision of that legislation is to include warning to consumers about making only minimum payment and how long it will take to pay off the entire balance if they make only the minimum payment, and how long it will take to pay off the entire balance and the total dollar amount. Information is important. Before the passage of the Card Act in 2009, college students graduate with an average balance that is much higher in average credit card balance that's much higher than after the passage of the act. Just simply seeing the information on their financial statement encourage people to make payments sooner instead of making the minimum payment. Before the passage of this act, credit card companies do not disclose this information, and consumers sometimes are not aware how much they are paying in interest charges. When they see the total dollar amount when interest is factored in, that gives them a much stronger incentive to pay off their credit card balance. Next, let's take a look at how those finance charges are computed, so that how the credit card company charge interest will no longer be a mystery to you. Interest charges are computed based on something called an average daily balance. The average daily balance is a weighted average. It's weighted by the date. So the average daily balance is equal to the balance times the number of days that you have that amount, plus the balance that you have for X number of days divided by the total number of days. This may look a little bit mysterious, but it's actually quite straightforward. We'll use an example to illustrate that. Let's say there are 365 days per year and 30 days per month. Then the finance charge is equal to your average daily balance that we computed times the APR divided by 365 days times 30 days. So this will be your finance charge for that month. Let's walk through an example to see how average daily balance is computed. Let's assume that the billing period is 30 days, and at the beginning, the card has a balance of $1,000. Here are the transactions. The user of the credit card paid $50 in day 5, and they spend $80 on day 15. There are no other transactions, and the APR is 20%. The balance starts at $1,000. After 5 days, you pay $50, so the balance will go down to $950. And you'll remain $950 for between day 5 and day 15. So for 10 days, your balance is $950. Then you spend $80, so you'll go up to $1,030 starting in day 15. No other transaction for the rest of the month. So the next 15 days, the balance is $1,030. Let's take a look at this in a graph that may make it easier to follow. So you start in day 0, you start with $1,000. You didn't do anything for the first 5 days. So for 5 days, your balance is $1,000. You pay $50. So the balance is now $950 between day 5 and day 15. So for 10 days, the balance is $950. You spend $80, that bumps your balance up to $1,030. That's between day 15 and day 30, so there are 15 days. So for 15 days, your balance is $1,030. To compute your your average daily balance, we take $1,000 times 5 days, because that's how many days you have $1,000 as your balance, plus $950 times 10 days, because that's how many days you have $950 as your balance, plus $1,030 times 15 days, and then divide that by a total of 30 days. So the average daily balance is 1,000 times 5 days plus 950 times 10 days plus 1,030 times 15 days. Altogether, there are 30 days total, so divide that by 30. Your average daily balance is therefore $998.33. The finance charge is based on the average daily balance times the APR. The APR is 20%. Divided by 365 days times 30 days in the month. So the finance charge for this time period is $16.41. To help you understand this better, let's do this. Let's pause the video and you try to figure out this problem. This is an example in the textbook, so you can also take a peek at the textbook if you need some help. In this example, Sam paid off or thought that they pay off the entire balance of $250, but at the end of September, they will still charge interest. So let's take a look at why that's the case. The bank charged $50 in late fee as soon as September 1st hit. Sam got the statement on September 5th, and as soon as they find it, they pay it right away. So they have a zero balance for 10 days until they purchase something for $300. As far as the bank is concerned, Sam's balance was $250 for 5 days, $0 for 10 days, and $300 for 15 days. Therefore, they have an average daily balance that is not zero. This is important to remember. As long as you have an outstanding balance, that entire month will be subject to interest. And oftentimes, if you have an outstanding balance in the beginning and you pay off all the bills at the end, you may still have an interest charge the next month. And the reason is because sometimes the bank do not add the interest charge before they send out the statement. In this particular case, Sam's interest charge is only $3.94. So the late penalty was much higher than the interest charge. So remember, finance charges are at the end of the billing cycle. When you check your statement, you want to make sure that finance charges have been included in the most recent month. Otherwise, you may want to make an estimated payment. Because if you don't, even if you pay off the entire balance after the due date, your beginning balance for the next month will still have the unpaid finance charge, and the following months will also be subject to finance charges. So you must pay off everything, including the finance charges for the month, in order not to accumulate interest in the following month. So knowing how to compute finance charges, you can estimate how much that will be, and you'll be able to pay that off before the bank posts it to your statement. In Sam's example, in the example where we have the $1,030, to avoid additional finance charges, you need to pay not just the $1,030, you have to pay the interest charge for $16.41 as well. When you're choosing a credit card, make sure that you choose it from a reputable bank. The CFPB publishes a list of credit card complaints, so try to avoid companies that have a lot of complaints. So avoiding company on the CFPB's list is a very good start. This is very important. Understand your own spending habit to make sure that you do not rack up those fees. Look closely at the value of the rewards, whether or not they are worth it. Read all the fine prints to avoid any surprises. The new rule for consumer under 21 is that you must provide proof of income, or you have to be co-signed by someone older than 21. And the reason for that is to encourage or to avoid uninformed consumers being tricked into getting a credit card and not knowing all the pitfalls that can come with credit cards. So credit card is a very useful tool for personal finance as long as you use it responsibly. We'll pause the video here. In the next video, we're going to talk about prepaid debit cards.